All right, we are live for another episode of the Blue Crocus Experience, and I'm excited about this one, guys. Often I bring on business owners, people in the trades and the industry that are talking about their story and talking about different things that they've done to grow their business. This is a little bit of a different guest. Murray was recommended to me by someone that I have gotten to know over the years, and I said this is something we need to talk about on the podcast. So Murray, welcome to the show. Excited to have you, and we'll kind of introduce the topic here once you tell a little bit about what you're up to.
Great to be here, Lewis. Thank you very much. I appreciate the opportunity. Very generous.
Awesome,
Yeah,
awesome. Yeah. So Murray's going to talk about business credit. It's something that everything financial. I think business owners as a whole they kind of just pretend it's not there a lot of the time.
mm,
And so building business credit gives you a lot of leverage and a lot of opportunity to do a lot of different things. Murray's going to get into that. So yeah, welcome to the show. Murray, if you want to give people a little bit of your background and then just dive into
sure.
your presentation, because it's going to be less me asking questions. I'll ask questions as I have them, but
Okay.
it'll be less me prompting you for things and more, really here to be educated. I know you and I had the call earlier. I was really excited about this, and I said, people got to hear about this.
Great. Well, thanks for the opportunity again. Very, very cool. Glad to be in front of as many people. I'm very passionate about leveling the playing field because I feel like the business owners, like your audience, uh, are the backbone of the country, right? And yet, they tend to get the shaft all the time. And so whenever I can, I'm very passionate about leveling the playing field. So a little bit about my background. I was in the Army 5 years, and then I had a 35-year career in corporate finance and manufacturing for three different Fortune 500 companies: Raytheon, Texas Instruments. Most people have heard of Texas Instruments, not the calculator division, the semiconductor division, which is 99% of their business, and a $12 billion company out of Boston called Analog Devices, which was also semiconductors. The point of me telling you that is not to brag, but the point of me telling you that is what I'm going to share with you about business credit. I had no clue, and I'm a career finance guy who had no clue about business credit, differences between personal credit and business credit as a company owner. In my corporate experience, I didn't have to worry about getting money. Big companies have so many more resources and the abilities to get money they need. There's a whole bunch of different options, which we're not going to go into on this call. So as a corporate finance guy, I was managing the money within a factory. And I had to get people to justify the money they wanted to buy certain machines with a certain budget, right? And I had to make sure that their justification lined up with what the goal of the company was. But I didn't have to worry about getting the money. Somebody else was already in charge. We had 100 people worrying about that. As a small business owner, don't have that kind of resources. When you are a small business owner, they don't give you a book and say, here's how to be an entrepreneur. Here's how to be a junk removal expert. Here's how to be a plumber. You don't get I don't want to be facetious, but they don't give you a manual on that. You became a plumber because you were passionate about plumbing. Or you were passionate about junk removal. You knew how to do it. You had some angles, but there's a lot of stuff that you don't know what you don't know. And that's true with life. You don't know what you don't know, which is, it can be a huge hole. And I'm here to tell you, I didn't know this, and again, as a corporate finance guy. So this is why I want to make sure that I share with you what I've learned, because I think it can really make a big difference. All right. So I'm going to start off by saying every company, I think everyone here will agree, Lewis, I think you'll agree that every company, every business needs money or needs access to money at some point.
Certainly helps.
Right? At some point. Whether you're an individual person selling stuff on, Shopify or somewhere online, or whether you're Walmart and everything in between, you just can't always live off cash flow of what whatever you're doing. There's some point in time where you're going to need to fill those gaps or, take things to the next level. So I'm here to tell you that the money for businesses is out there, at least right now, although things are getting tighter, as we speak. But the problem is not is the money out there. The problem is business owners don't know how to get there, don't know how to get to it. So I'm going to hope to clear some of that stuff up.
Love it.
Okay, sound like a good plan?
Sounds good. Yeah, we've got a few people viewing. Tim, appreciate you. Tim's
Keep it
here.
simple.
Keep it simple. Yeah, I
All
think
right.
I'm looking forward to it. So yeah, if you guys have questions too as we're going, drop them in here and I'll bring them up on screen for Murray to answer.
Awesome. All right. So I think the first thing I'd ask somebody on this call is, what is your business score? What is your business credit score? And every time I ask that to just about everybody I've ever talked to, they don't really know. I mean, most people know their personal credit score, but most people don't know what their business credit score is. And here's the thing, it's public information. So whether you know it or not, somebody else does. The banks know that, your competitors know that, your vendors know that, your clients know that, or they could know that anyway. So it behooves you to look good for the business credit bureaus, because you need to make the best possible representation of yourself if you're going to succeed in business. The second thing I always like to ask people is, are you business owners, I should say, are you personally guaranteeing loans? Right? And I'll explain what that means. But it's really unfair that most banks require a social security number on a business loan from a business owner before they'll be considered for to be on the loan application. So let me start with that. Okay. Most business owners that I talk to have set up their business as an LLC. Okay. LLC stands for limited liability company. The whole point of doing that is to keep the liability within the company. That's why you set up an LLC, and not have the liability extend beyond that to your personal assets. There's two ways to puncture that corporate veil of protection that is created by the limited liability company. One of them is if you commit fraud. Okay, we're going to move that up for another day. The other way you can puncture that veil of protection is if you sign your social security number on a business loan or on a business credit card application. Once you do that, the company can't protect you, from liability. You're putting your personal resources on the line, which is something that's massively unfair and very stressful. And there's probably people on this call who had to do that. And the problem is banks don't want you to know that there's a way around that, right? Banks are in the business of personal guarantees. They don't want you to know that there's another way around that. They want the collateral. They want to be able to get their money back, whether you pay the loan off or they're going to have some other kind of way to get to your assets. I don't have to tell you, you don't want to do that, right? I mean, I think it's just obvious, but most business owners either don't want to do that or they don't know there's another way around in that. So we're going to hopefully give you a way around that legitimately when you build business credit. Okay. So let's talk about the differences between business credit and personal credit. I think it's important to understand that before we talk about building business credit, because you need to know why they're different. Because what you want to do, this is accounting 101, ladies and gentlemen. I know no one on here is probably an accountant, but this is somewhat common sense. You never want to commingle business and personal finances, right? As a general rule, you want to keep everything separate. But effectively, when you put your social security number on a business loan, you are effectively bringing your business into your personal credit, right? So you don't want to do that. So we're going to show you how to do that legally and, in a way that a highly recommended way to make your company so that you can get the access to the money you want when you need it and not put your personal assets at risk. All right?
Love it.
Good so far? So let me go back now. So let's talk about the differences between this hand is going to be personal credit, all right? And this hand is going to be business credit. And the rules are different. Who knew that? Who knew that the rules are different? I mean, I didn't know this. So I'm going to guess some of you guys on this call probably don't know this. So hopefully this will be enlightening for you. You might get pissed off, but this is how it works. Personal credit. A lot of people have a pretty good idea of that. In the U.S., building personal credit starts automatically when you turn 18. And once you turn 18, everything you do financially gets reported to the 3 credit bureaus in the consumer credit side. Everything is tied to your social security number, right? Everything you do, a dossier of transactions gets built and sent to these credit bureaus. They have a record on you. The key word there is automatically. You didn't have to do anything. You didn't sign anything or hit a switch or push a button. It just automatically happens by law. Businesses have to report personal credit and personal financial transactions to the business credit, to the consumer credit bureaus. That happens automatically. Out of all that, through some algorithms and stuff, they create a FICO score, right? The FICO score range is somewhere like 300 to 800 or 900. And the sweet spot is about 740. Once you hit 740, banks want to talk to you. Most people have somewhat of an idea of what their FICO score is within a couple, 10 or 20 points. All that happens automatically, and it's required by law. And the idea of that number was to give lending institutions some kind of measure of your ability to pay back a loan if you apply for a loan, right? It's a measure of your ability to pay, right?
Will they get their money back is all they're worried
Will
about.
they get their money back? Exactly. And the higher your score is, the better terms they're going to give you, right? And if you have a low score, you're either going to get lousy terms or you're not going to get approved at all, right? And so that's the yardstick. But the key word, and I'm sorry, let me stick with this hand. The key word I want you to remember, excuse me, I hope no one gets this cough I have. The key word I want you to remember is it's automatic, okay? By law. Now, everyone kind of knows that, and everyone kind of knows the 3 credit bureaus, which are TransUnion, Experian, and Equifax. Let's talk about business credit. Number 1, the scoring is different, 0 to 100. All right, that's not a big deal. It's just different numbers. It's meant to be the same thing. 80 on a scale of 0 to 100 is sort of the sweet spot. If you can hit 80, that's like the equivalent of a 740. That in itself isn't a big deal. Next, the credit bureaus are different. It's not the same. You got Dun & Bradstreet is the big gorilla. People are pretty familiar with, have heard the name, Dun & Bradstreet. Then you have Equifax Business and Experian Business, which are different organizations than the consumer side. That in itself isn't a big deal either. That's just differences. Here's the real big difference, though. Okay, and I want everybody to swallow this. This is a big deal. If you want to build business credit, you have to do it intentionally. It's not automatic. And the reason is, one of the reasons is, it's estimated that less than 10% of the transactions from the business side get sent up to the business credit bureaus. Less than 10%. On the personal side, it's 100% required by law. On the business side, less than 10%. It's not required by law. Why is that? Why, it doesn't make any sense, but that's the way it is. So what does that mean to business owners? Well, you could be paying off a loan or paying off a credit card or whatever, thinking, you're building your credit, and if I pay this early or pay it on time, it's going to make me look good. But there's a 90% chance that the recording of that transaction isn't going anywhere. Can you believe that? I mean, how's that? It's just mind-boggling. So why is that? Why is that? Well, number 1, it's not required by law.
So
number 2,
if it's not required.
Exactly, on the business side. Number 2 is it costs them a little bit of effort and a little bit of time. Not much, but enough that since it's not required, there's really no incentive for them to do it. And there's other reasons too, like certain credit cards don't want to report to Equifax. I think Equifax had a data breach, right? And because it's not required by law, they don't want to send their clients' information to Equifax Business because of that data breach. it's just kind of bad blood there, right? So for whatever reason, the primary one being it's not required by law, most of the transactions never make it to the destination of the credit bureaus. Isn't that like, unless I'll say this, of the good transactions, if you screw something up, they're definitely going to report that. All right, so of the 10% of the good transactions, meaning you're paying stuff off on time, make it to the credit bureaus. Most of them don't. Does that make sense? I mean, it doesn't make sense, but do you understand what I'm saying anyway, right? So that is a big difference. The other big difference is the underwriting rules for business credit are different than personal credit. On the personal credit side, as you get more and more debt, and as more and more credit and more debt, you start to hit a ceiling, because there's other metrics in play, like what is your debt to income ratio and what is utilization and all this other stuff. And at some point, your score is going to be hurt with the more debt you get on, right? And your score is going to go down, meaning you're going to get lousier interest rates or possibly denied altogether, right? In business credit, the overriding principle is you have to have a demonstrated ability to pay in terms of underwriting. And we have to make sure it gets reported, which again, 90% of the time it doesn't. But you have to have a demonstrated ability to pay. If you do have a demonstrated ability to pay, they want to give you more credit. So it's just the opposite of personal credit, right? The more credit you have and pay off, the more they give you, right? The personal credit side is more exasperated if you start commingling your business into your personal credit, or saying another way, if you start putting your social security number on the application, that's going to be measured against your personal credit. So you're really going to exasperate your personal credit score if you start bringing your business expenses in too. It's going to hurt your business ability to borrow, to get a mortgage, for example, or to buy a car for your home, a personal car. It's just the negative effect is magnified because you're bringing in more stuff that should be not commingled with your personal stuff. But when you put your social security number on there, that's in effect what you're doing. So very painful. Let me give you a couple stories and anecdotes. Excuse me. So in credit cards, which are an awesome tool for anybody, whether on the personal or business side, you have personal credit cards, you have so-called business credit cards, and then you have corporate cards. You can go to Home Depot and ask for a business credit card. And I'm picking on Home Depot, but this applies in a lot of different places. Home Depot has a business credit card, and it says right on the card, business credit card, Joe Smith, right? Or Joe Smith Enterprises. But if you go up to a clerk at Home Depot and you say, I'd like to get a business credit card application, on the application, it says, what's your social security number? And they don't report to the business credit bureaus. So there's literally nothing about that business credit card, because it's tied to your social security number. There's really nothing about that makes it a business credit card. They may give you some more perks for, like, travel points or something, but they don't keep it separate from your personal credit, and they don't report when you pay it off on time. What you really want is the corporate card, and you have to ask specifically, and probably the people at the Home Depot store aren't going to know what you're talking about. You have to ask for the corporate card with the net 30 terms. And in the business side, when you're paying bills off, paying them early gives you a little extra juice on your score. So you want those net 30 cards, and you want to pay those off earlier. Here's the irony. Let's talk about American Express for a minute. American Express has a bunch of business cards, and some of them get advertised on TV. It's the same kind of deal. They have a business credit card that doesn't report. It's tied to your EIN and your social security number. Whoops. Social security number and your EIN. They don't report, and it's basically giving you requiring you a personal guarantee because your social security number is on it. So it's not helping the cause at all. It's not building your business credit, and it's holding you personally liable if something goes wrong. However, if you get to a score of 80 in the business credit world, suddenly you'll start getting offers from American Express corporate card saying, hey, congrats, join the club. Here is our corporate card. Here's an application for a corporate card. What's your EIN number? And those are tied to your business EIN, and they report. But who knew that? You don't know that. You don't know what you don't know. It's impossible to make it any more complicated than what it is. And so hopefully this is it's not going to eat, but it's which may be preventing you from getting the business credit you really want. So am I with everybody so far? Does that make sense so far, Lewis?
That makes sense. The burning question on my mind, and I'm sure you're going to get to it here, is,
go ahead.
What does someone do? Because I was thinking American Express would be a good option. So start walking us through that process. What do we do as business owners?
So a couple of things. All right. First of all, what you want to do is you at the end of the day, you want to look, smell, and feel like and taste like Walmart to the business credit bureau, so that your presence, you as a company, Joe Smith LLC, looks good enough that the business owners the business lenders want to lend to you. You have to find the right people to lend to that do give you a true business loan or a true business credit card, right? Which we can do that for you. But you need to ask that. If you don't work with us, that's okay. You need to ask that question. Do you report to the business credit bureaus? And where I want a true business loan against my EIN. Now, look, most banks aren't going to offer this, particularly the big ones. The true banks that do offer business loans, true business loans, are usually the smaller regional banks. Now, I can't give you any names, not because I don't want to, but because everyone's going to be in a different place. So you want to ask that question: do you report my transactions to the business credit bureaus? Now, we have a solution, which I'll talk about in a minute, that can help you navigate through all this and can help speed things up. Amazing. But let's start with the basics first, okay? The very first thing you need to do is, and I just had a client today, it's unbelievable. The very first thing you need to do is you need to get what we call the 125 fundability points, all accurate and consistent wherever you have a presence on your business online. What the heck does that mean? So there's a company called LexisNexis, which is like Big Brother. They have all data on everything, on everybody, on every business and all that. And when an underwriter is looking for your business, to see if you qualify for a loan, they're looking wherever you are to see if everything lines up. And what they're doing at this step is they're seeing if there's any potential fraud. What do I mean by that? The easiest example I'm talking about is your business address. That's an easy example, right? So you'd think that's an obvious thing. So first of all, if your business address is a P.O. box, you're going to get rejected. If your business address is a home address, there's a high likelihood that you're going to get rejected. Not always, because it can be justified, but there's a reasonable probability that it will get rejected. The issue we see with a lot of our clients are that they have like 5 different addresses. They have an address of their bank. They have a business address, I'm talking about, a business address with their bank. They have a different business address on their website. They have a different business address on the registration where they register their business with the Secretary of State of the state that they're in. And they have a different business address with the applications they're making, and a different business address with the IRS. Because when when they originally set up maybe that registration with the Secretary of State, they put some address on there, not thinking that I got to make sure that's a real address, or maybe they moved 10 years ago and forgot to update that. I had a client today ask me what his business credit score is. He's got 6 different companies showing up on the state of Texas that are some variation of his name. Some of them have a comma. Some of them have the word, Elm Street spelled out and Elm ST period. So there's a whole bunch of screwed up. There's a whole bunch of duplicate data, and the guy who's underwriting the deal doesn't know which one is real, and they think it might be fraud, so they're going to get rejected. So the idea is you got to make sure everything from the comma and the period of your address, wherever you have a presence, is consistent and congruent, and that gives you credibility, right? That gives you credibility, and you pass that first step. I'm going to say that over half of your loan, your business loan rejections are going to come because your address is not consistent.
You know what's crazy about that? It's the same with SEO. Google is confused when you have multiple addresses and names and everything out there. So that's
it's 100% the same as SEO. They're using kind of the same logic, right? Somebody is like manually SEOing, the presence of that client, the client. And if you aren't consistent, Lewis, there's a big emphasis on fraud nowadays, right? And they're going to flag you for fraud. And then you know what? Here's the other thing that's criminal about that. They don't tell you why you got rejected. So you got rejected for this loan. You don't know why, and you can't reapply for several months. And if you don't fix what was wrong the first time, you're going to get rejected again, right? So, or you have to go to somebody else. But it's very frustrating. The deck is stacked against the small business owner. So step 1 is to get all the data right. Here's another piece of data that no one would ever think about, but just as an example, very few of our clients, you got to have an email address that's not Gmail or Yahoo, or some one of these. It's got to have your domain of your business, in the address to make it look like a real address. Again, they're worried about fraud, right? You can't be Joe's Plumbing, the owner of Joe's Plumbing, and your email address joe@gmail.com. You're going to get rejected, right? You've got to look, smell, feel, and taste like Walmart to the credit bureaus. Here's another stupid thing. So some of these things kind of make sense when you think about it, but others are really dumb. For example, there's a thing called Online 411, which, as far as I know, when the internet first came out, it was sort of like 911 for the internet. It was designed like an emergency thing, and you had to be registered with this. It was, online yellow pages and all that. Well, that's long since been, no one uses that anymore. But what they don't tell you is you got to be registered on that to get approved for business loans.
It looks like the site was last updated in 1999.
Yeah, it's not so. But you have to add your name to that. Now, it doesn't cost anything to do that. But if you don't know that, you don't know that. You want to stack the deck in your favor, right? You want to get all these trivial things. I say there's 125 possible pieces of data. Most of them are not applicable to most companies, but you have to look consistent everywhere someone's looking for you, Otherwise, they don't know if you're real or not. And they really want to mitigate their risk because they don't want to, for obvious reasons. They don't, is this company real? Is it this address or that? Who are these guys? We're going to reject them. So step 1 is to get all your business addresses and all this business data correct and consistent everywhere you are represented, where somebody can see you, where your company's presented, publicly, which includes your online presence, right? So since you work in SEO, you're kind of like, that was a great observation, by the way. Very, very similar concept. So once we get all that worked out, again, these things all increase the chances that you're going to get good business credit. The next step, these are our 7 steps, which we recommend. I think it kind of makes sense. We distill it down to 7. Step 1, that's the most important one, is getting the data set up. Step 2 is we got to register you with the 3 credit bureaus. Okay, there's actually more than 3 in the business world, but we're going to work with the big 3, which I just mentioned a minute ago. Dun & Bradstreet, Experian Business, Equifax Business. You got to look good for all 3, because you don't know where they're going to pull the credit from, the credit score from. So what we do is we take all this infrastructure, all the data we just created and streamlined and got consistent, and we take all that and we register that same data with the 3 credit bureaus, so that when a transaction happens, and anything, when there's data involved on the online, everything is going to match, so a good handoff is made, right?
Yep.
We had a client today, the same client that had all these different addresses has 4 different business names on Experian Business. So when somebody's reporting their transactions, who knows which one it's going to, if it's going to at all. You know what I mean? It's the same kind of deal. We've got to make sure that you only have one presence on each of these 3 bureaus. You're represented, but only once and with the right information, so that when transactions do occur, we're going to increase the chance it's going to get there. That makes sense? It's basic data 101, right? So here's a story, that kind of amplifies that a little bit. And you got to look good on all 3, right? There was a guy, before he was a client of ours, apparently very well off. He paid with a credit card. He was telling us the story. Pretty funny. He bought a plane for his business
on credit card.
On a credit card. So the guy's doing pretty well, and it got approved. So I'll tell you a little bit more about the thing he was doing to get that approved. But he got approved. So a few weeks later, he used the same credit card and tried to buy a pickup truck for his business, which conceivably is a lot cheaper than a plane, right? And he got rejected. And he's like, yeah, I just bought a plane on this credit card a few weeks ago. What's the deal? So we looked into it, and he had a great score on Dun & Bradstreet, but he didn't do anything with the other 2 credit bureaus. And we think that they pulled his credit from, Experian Business for the pickup truck, and he really didn't have anything showing up there that indicated he was a good, risk. So he got rejected. So here's what we found out, and this is a little bit of a side track, but I do want to bring this up because about half of the people I talk to experience this. So this is a warning. Dun & Bradstreet is still the big gorilla on the business credit side. You have to have a good credit score with them, like you do the other 2, if you're really going to have success with business credit. But they have this program, which this really drives me nuts. So I have no problem spilling the beans on them, because I think it's criminal what they do. They have, I'm going to call it pay to play. They call it business credit builder, right? You pay them an exorbitant amount every month, and they artificially increase your score, so that if anybody pulls your Dun & Bradstreet score, you look like Walmart, right? The problem is that's fake. And like this airplane guy, it doesn't help you in the other credit bureaus. And if you stop paying them, your score goes back down to 0 or some low number, not to the inflated number that they had you at. And there's a host of other problems I've heard from clients who, just the customer service and all that. It's just a bogus program, and they market it extremely hard.
Moneymaker.
It's a moneymaker. And once you get into their marketing loop, they got their claws in you. So I would caution everybody to be careful on that. What I'm talking about building business credit, I'm talking about legitimately building your credit score in a legitimate legal way, and not this artificial business credit builder program that they have, which, I don't know how they get away with that. I think they did get sued by the SEC. I probably should verify that before I say it publicly, but I'm pretty sure they did. To me, it just seems like a massive conflict of interest. But anyway, just a heads up, be careful on that. You know, I had a few clients, or I'll say prospects, try to turn me off because they had participated in that and it wasn't successful, and they thought that's what I was offering, and that's not the case. We're trying to build your credit legitimately. That's what we do. Okay. So let's get back on track now. So step 2 is you want to make sure that all this data on you is accurately reflected in the 3 big credit bureaus, so that when transactions do get reported, they go to the right place and someone can pull your credit score and it reflects accurately where you stand with your business credit.
Very cool.
You with me so far?
Yep.
So this is the way we do it now. And I'm hoping you can kind of do it on your own. If you want to try it on your own, you could try this. The next step, we're on step 3, is to set up 3 or 4 accounts with those 3 with vendors, okay, with vendors or lenders who do report to those 3 credit bureaus. And you got to find out, one of the tricky things here is you got to find out which vendors do that. Now we have a back office of people, of vendors and lenders who do report. That's part of the agreement we have of working with us. You know, you have to report. You have to tell us which credit bureau you report to, and we have to know your terms, your underwriting rules in advance, so that when our clients do request a loan or a credit card, we'll know in advance they're going to get approved. So there's no mystery. It's all known up front. And when you deal with our guys, they do report. So you can methodically, step by step, build credit. So let's get back to step 3. We want to do baby steps. We want to set up what we call tier 1 lending. 3 or 4 small accounts, and we're going to prove that everything works. All this data we set up and the registering you with the credit bureaus, we want to make sure it's working before we go hog wild. So we recommend, obviously stuff that you're already buying. Set up an account. For example, a plumber might need Home Depot or Plumber Supply or somebody like that, or a gas card, right?
Everybody needs those.
Gas card is something, junk removal companies and plumbers both need. So gas cards are a great starter account. You got to get a gas card that does report. Not all of them do. And again, you don't have to put your social security number on it. But before you can get these big business loans, you got to start out small, and they want to see proof that you are able to have a demonstrated ability to pay on a small level before you graduate. You know what I mean? It's kind of like school. So what we recommend is open up a $50 gas card on XYZ, open up a $50 Home Depot card maybe, and maybe a $50 Uline account. I don't know if you know what Uline is.
Yeah, Uline's great. Yeah.
They sell everything, right? Uline has a program. If you just go to Uline online as a business owner, it's a personal credit card with the name business on it. But we have a Uline vendor that does report. It is a true business card with your EIN number, and they do report, right? So open up a handful of accounts, buy $50 worth of stuff that you're already going to buy anyway, right? We don't want you to change your spending habits just to create credit, and then pay it off early, right? A minute ago, I said, and just to reiterate, in business credit, and by the way, these are going to be net 30 accounts by the nature of the fact they are business accounts. They're true business. In business credit, paying it off early gives you a little extra juice. So when it comes to business credit, you want to do that. So that's step 3. Step 4, we want to make sure that stuff we just did actually made it to the credit bureaus, right? So it may take a month for them to process everything and for it to be recognized at the credit bureaus. But we want to make sure that, that gas card you just bought $50 worth of gas and paid for, that actually got reported up there that, oh yeah, Joe Plumber did pay that. And it's reflected accurately on your credit score. So we want to make sure you pass, step 1 before we go any further. It's called credit monitoring at a very elemental level.
Yeah, that's great. Everybody, any trade needs gloves, needs equipment from Uline, and gas. Everybody needs gas. So yeah, that's
Yeah.
perfect.
So you want to start off small, and that's what we do. All right. Um, so then once you prove it out that because otherwise, if you think you're building credit and you don't have everything lined up, again, you're with this 90% that doesn't get reported. It's not going anywhere, right? So you not only need to make sure you're talking to somebody who is reporting, but that everything is lined up and it actually is hitting there, right? So that's really what we're doing. So if all that's good to go, the last 3 steps are just building more trade lines, more accounts with more vendors or lenders that do report. And you're just building up, a demonstrated ability to pay. Remember, that was the underwriting rules. You're developing a demonstrated ability to pay, and it's being reflected on the credit bureaus because the transactions are going to be accurate now. And the skids have been greased, and you're working with people who report, and everything is hitting and everything. And so, if you had to draw a line of building your credit, right? Whoops, I'm getting tangled up in my cord. So at the beginning, so this takes time. We tell people it takes 9 to 12 months.
Mhm.
Okay. So it's not instantaneous. And again, remember, you have to be intentional. But as you're building your credit, it starts off slow. And, by month 2 or 3, you're going to get gas card credit, 10 grand maybe. I can't give specifics because everyone's different, but you're going to get small credit, at the beginning. It's not like you don't have to wait a year to get anything. And then as you start building these tiers, it starts really ramping up. So let me give you an example of a client we had to kind of illustrate how it ramps up. So this isn't in the junk removal or plumbing space, but the concept is going to apply. We had one of our early clients was a transportation company. It was a very small family business. A woman owned, I think it was like 5 big trucks, and she was out of Oklahoma, and they were like $1.4 million in revenue. Okay. By the way, there's no revenue limit to work with us. Okay, it's just a matter of whether you think it's worthwhile. All right. Anyway, let's go back to this woman. We pulled her credit report before she started working with us, and the credit report, she had a lousy score, and in business credit, it says, we recommend her, their recommended credit limit is XYZ. For her, when we first started, it was $1,000 of business credit. Now, if you're a $1.4 million company and you get $1,000 of business credit, you might as well, buy a cup of coffee with that, right? I don't want to laugh, but that doesn't really move the needle too much,
Yeah.
So clearly she was almost at ground zero. So we started working with her. We started off with some gas cards, which is an obvious, nice solution for somebody who's in the transportation business. And by, I don't know, month 3 or 4, we had her up to like 30 grand.
Wow.
Which is not bad, but could have been better, right? And so we started with some more expenses that she's already paying, and we, for example, utilities. This is mind-blowing, right? Most people are paying utilities for their business. If you have an office, you got electricity, water, phone bills, whatever. So we have a vendor that you pay your utility bill to him, they pay for you, and they report to the credit bureaus that you're paying your utilities. You're paying your utilities anyway, right? What if you could get credit? What if you could demonstrate to the credit bureaus that you're paying this every month? If you got $1,000 of utilities a month, I'm just making a number up, I don't know, over the course of a year, that's 12 grand, and that's a multiple of.
And what percentage would that vendor take?
You mean the guy who pays the bill? Oh, there's a small fee for that. That particular vendor, there's a small extra fee not covered under our services, but I'm telling you, it's worth it. But I honestly, I don't know. I should know that.
But it'd just be a small percentage of it.
It's small. I don't think it's a percentage. It's a flat fee. It's probably like $10, $30, I don't know, a month. But if you can build credit on that, it's certainly worth it. You can decide whether it's worth it. I'll say that.
So let's get to the brass tacks here. This has been great. So now someone's kind of gone on this journey. They're building credit. Let's say they have 40K available, 50K for easy numbers. What does that mean? Does that mean they can go get a loan? They can get that loan from an approved vendor or someone who's actually going to look at their business credit for a vehicle or for equipment, stuff like that? Like, how does this actually translate to a benefit for a business owner?
Excellent question. So, what you want to do is get to a tier 4 lending, okay, which is our step 7, which is basically that baby step I talked about at the beginning with the gas cards and the U-line, but magnified with more, right? When you get to this tier 4 lending, it opens up. If you work with us, there's like a checklist, right? And it's like grade school. As you go to 6th grade, now you're open to more options. By the time you get to tier 4, if you pass all those thresholds and everything gets reported, now you might get a green light to get a line of credit from one of our banks, or a bank you could find that loans does lines of credit against EIN numbers, right? Or now you could qualify for a car loan of 50 grand because you're at this level where you have a demonstrated ability to pay, and then it opens up doors to vendors and lenders that you didn't know existed. You could get loans possibly for accounts receivable. Like I didn't even know any of this stuff was possible. I just thought there was basic loans and lines of credit. But you can get loans against your accounts receivables based on the fact that you got good credit score, and the fact that you have accounts receivable is a high probability that you're going to get paid. But for example, a contractor, sometimes they can't bid on the next job or hire somebody for the next job because the guys on the first job haven't paid yet. But if you show an accounts receivable and you have good credit, you could get an accounts receivable loan to cover that little timing difference, right? You could also,
before you wouldn't even have the option to avail yourself of that, but now you're going to get better interest rates because of it.
100%. So it's not like, so if you getting back to your original question, it's some combination. If you got a credit limit of 50, let's say 50 grand to your example, it could be a line of credit for 50. It's most likely a combination of gas cards that total 50 and, maybe a car loan for 30, some combination could get you to 50 total credit. Okay. That's what they recommend. And it's usually a pretty good indicator of what you can get. But the bottom line is you want to keep building that with demonstrated ability to pay. And it just opens up things so much more than you thought possible. I don't know. Does that answer your question though? It's usually
some of the guys doing commercial work. This is something I see in the groups. They're like, where can I get, something to? Some of them are net 90 days. Oftentimes you can work your own terms, but some guys don't know that either. But to have that ability to have the working capital to do the job, to pay your guys before you get paid, that's a big deal, and can be the difference. That's a big deal. Landing a 100K job on those terms versus the normal 5 to 10 jobs. Yeah.
Great observation. Yeah. And this is really leveling the playing field because, and again, all of this, when you do it correctly, there's no personal guarantees. So let me go a little further here. Just about all of our clients have some amount of personal guaranteed business loans that they want to get out from under as part of their motivation for even talking to us, right? Again, this hand is personal guarantee, right? When you get to a certain point, you can start refinancing. For lack of a better word, you can, refinance debt XYZ or credit card XYZ that you sign your social security number on, but it's really a business card. You can put it on a true business card now and get it off your personal credit. So one of the unintended but pleasant side effects of building good business credit, it could improve your personal credit. Unintended.
You're taking that liability off of it and cleaning things up. Does that close the veil again, for lack of a better? I'm not sure if that's the right term, but
on that particular debt, yes.
Yep.
Yes. analogy is not the right word, but in that definition, it's that you're puncturing the corporate veil protection on a debt by debt basis.
Yep. So if you cleaned
Right.
up all your debts, got them all over to business, you would have cleaned up that
You
issue
would have
there.
cleaned up your
Yep.
yeah.
Amazing.
So let me throw a couple more things at you to think about, and then I got to tell you the bear story. Don't let me forget the bear story. So, by the way, how are we doing on time? Am I way over?
We're good.
Okay.
We're good. Yeah.
So this is important, and a lot of guys don't think about this. And I don't know what the age group of you, but at some point, if you own a business, there's going to be a transition, right? You're either, hopefully, you're going to sell your business, or you're going to give it to somebody in your questions. A worst case scenario is it just dissolves and you sell your assets. You don't want to do that. You want to do a little bit of prep work, right? And there's a whole industry of consultants who can help do that. That's not the point of what I'm going to say here, but I'm going to tell you something that will help you. There's a way when you sell your company or when you transfer your company to your family, the EIN is attached to the business. So it doesn't happen automatically. You have to make the transfer certain buttons you have to have set to make this happen. It's not, you can't assume it's going to happen, right? But it is very possible and probable that you can transfer the EIN with the business. Are you with me? So if you built if you put all this work in to get a good business credit score, you can transfer that with the business. It's going to make the business much more attractive to a buyer, right?
Mm.
They're going to have like a built-in, credit score that's going to help them hit the ground running. The converse of that, if you don't have a good business credit score, and if you've got a bunch of personal loans that are hanging open and you're trying to sell that business, the buyer is, I'm pretty sure they're not going to assume those loans. That's going to be your problem. And so if you want to pay those off, it's going to come out of the revenue you get when you sell your business. So in other words, you're not going to get as much as you thought if you want to pay those off. Does that make sense?
Tons of sense. Yeah.
So think of it as a long-term strategy. There's two ways that this directly affects the value of your business, which is hard to think about in the daily grind. In the daily grind, you're just trying to survive. But at the end of the day, you want to grow the value of your business. And number one is, when you have access to money, you're going to be able to do more things that can increase the value of your business. You're going to be able to buy more trucks, hire more people, buy more supplies, do more marketing, hire a part-time CFO. There's all these things that you probably never thought of, right? I'm going to get into that in a minute. The second thing you can do is build a good EIN so that when you sell the business, you're going to get more for the business. So this is a great strategy to increase the value of your business. This is a great strategy to mitigate risk because, as we've said a few times, we're taking out the personal guarantees. All right? Let me tell you a quick personal guarantee story. The guy who shared with me about this whole concept was a real estate investor. Now, I don't know if anybody on here is a real estate investor, but this guy was really good, and he was a builder, he was a investor, he was a owned a real estate company, and he had $18 million of real estate assets. And this is in 2008. How old are you, Lewis? Well, no, don't scratch that. You're old enough to remember the 2008 crisis, right?
I am, yeah.
Which was associated with real estate.
Real estate and
right?
Demolishing business assets.
100%. So this guy was paying everything on time. He was a very respected member of the community. He was, what do you call it? The Lions Club or all these, Chamber of Commerce. That's the word I'm looking for. Everybody looked up to this guy. He was successful and all this, and everything hit the fan in 2008. And unbeknownst to him, the government, well, I guess it was known to him, but the government was offering banks 70 cents on the dollar for any bank loan that was real estate oriented. Because the logic was real estate's a big risk. We'll give you 70 cents on the dollar so you don't lose everything, right? So this guy had a whole bunch of loans. And one of the smallest loans he had, they pulled the loan out with this, they called it the TARP program. And that acronym stood for something which is irrelevant. But it wasn't, they pulled the loan. It wasn't because he did anything wrong. It's because of some external factor that he didn't control. Think about that for a second. That, in turn, created a domino effect. And all the other bank loans he had, the banks were looking at that like, oh, something happened. That guy got his loan pulled. We got to pull his loan that he has with us. In summary, in a few months, he lost $18 million plus his home because everything was personally guaranteed.
Oof.
Can you imagine that? And he did nothing wrong.
Wow.
Now,
So one lender just decided not to. They were having cold feet. They were probably going through their own issues, pulled his loan, which created all the other ones to, wow.
That's right. Now think about COVID, which is out of everyone's control, right? How many businesses got shut down because of COVID? And if they had anything personally guaranteed, I mean, that wasn't anything they did wrong, necessarily. But COVID impacted so many businesses in different ways. It just changed the whole, we just went through that. So you know what I'm talking about, right? So what if something happens, God forbid, like COVID, if you think about nowadays, there's at least 70 different things that could go wrong, that they're just waiting to happen, like COVID, that, pick your black swan. You don't want to put that risk on your personal assets at risk, right?
So if he had had it all under business loans, what would have happened?
His business would have went down the tubes, right?
And the banks wouldn't have gotten anything.
Yeah, but the banks wouldn't have gotten into his home anyway.
Yeah.
I mean, he may have had legal issues trying to get, start another business or something like that, but it wouldn't have affected his family, his home, his 401k, his kid's college plan. All those things are at risk if you put your social security number, because the banks want their money. They want to know that they're going to, if they loan you something, they're going to get it back one way or the other, right? And so,
unless there's a stop.
Yes.
Yeah. Wow, that's crazy. So he lost everything. Like he
lost everything. Yep. And now he's a smart guy. So I won't say I don't know where he is. He's not at 18 million, but he's in good shape. Okay. But he went through some hell there. So this is a risk mitigation strategy. You don't want to commingle business with personal stuff, right?
Same along the lines. If you got sued or anything in your business, you damage someone's property, they sue you.
Yeah, and I never even talk about that, but that's 100% accurate. Yeah, you God forbid that happens, but you want to keep that against the business. My God, I never emphasized that enough. But yeah, you could get sued, and it's going to be the business that's going to take the brunt of that.
Because that's even if you don't have loans, right? Because I know a lot of guys.
That's right.
They built it. They built it off the cash, right?
That's right.
So yeah, that's 100%. Interesting. What's the bear story?
So this is like 80% accurate. All right, but I think the concept is correct. Somewhere in Eastern Europe, there was this is, I don't know, in the 60s or 70s or 80s, there was a guy who had a roadside attraction. He was trying to get people who were driving by to stop and go spend money at his roadside attraction. And I don't exactly know what it was, but the big lead magnet, you're an SEO guy, the big way that he was trying to get people's eye was he had a bear, a real bear in a cage that was 10 by 10, prominently, right alongside the road. People would stop and say, what the heck is this? You don't see a bear in a cage every day when you're driving around. This bear spent all day long in a 10 by 10 cage, just walking in a circle. Okay. And it was incredibly depressing. As you can imagine, and it was years, this bear was in this cage, and so animal activists or various people were complaining. At some point, finally, I don't know how many years it was, they ended up making a deal with the business owner that they would buy the bear from him and they would go free the bear into the woods because they felt like that was the thing to do. And sounds like a good idea. So they did that, and then they videoed the bear in the woods later on. And they saw the bear was no cage. The bear was in the woods walking in a 10 by 10 circle, and you could see the vegetation was worn out because the bear had been conditioned that was his life.
Oh.
Right? Can you imagine how horrible that is? So the moral of that story, what does that got to do with business? Here's the moral of the story. In my opinion, most business owners have been conditioned to operate with blinders on. And most of them are operating from a space of not abundance, the opposite of abundance, scarcity,
yeah.
Right? Am I going to be able to make payroll next month? Geez, am I going to be able to pay this loan? Am I going to be able to do this, do that, right? And they're just thinking like how to make it to the next day, But if they have access to the money that they need when they need it and know in advance they're going to get it before they apply, and it's not going to be personally guaranteed, they can take the blinders off. And it opens them up to so much more than they ever thought possible. When we talk about these loans, like that accounts receivable loan,
yeah.
I'm going to bet a lot of business owners have never thought about that. There's a whole bunch of there's like a whole menu of lending options that are open to you if you have a demonstrated ability to pay and if you have a good credit score, right? Now you can go pay for some market. Geez, I never thought I could market. I don't want to have my son, do Instagram videos. I want to pay somebody who knows what they're doing and start marketing, my junk removal platform and start getting SEO, right? Yeah. Hire more of guys like Lewis, right? Before I'm thinking, geez, I don't know if I can afford the high-end Lewis package. I can only afford the entry-level package, right? Or whatever. I'm throwing stuff at walls here. But what if I could get a CFO to come in and I don't know how to, set up my QuickBooks here? And what if I could get a bookkeeper, so I don't have to worry about this accounting crap. I can focus on plumbing.
Yeah.
I know how to do plumbing. I don't know how to do all these other things that are required as a business owner that really might not be in your wheelhouse. You can get the experts you need that know this stuff. I mean, you could build credit on your own, but you're probably not going to be able to do it in this fast amount of time, and it's going to take time away from what you're really good at.
Now I'm putting just a little on the spot here, Murray. But what is someone looking at to jump in with you guys?
So our motto is no company left behind, kind of like the Marines, right? So it doesn't matter what your revenue is. We have the same prices. We have two pricing models. We have let me tell you what you get though first.
I'm ruining your pitch here, but
no. I really mean to go into that. So thank you for transitioning. So what let's talk about what you get. So you get, number one, the core of the program is a software platform that kind of is a step-by-step menu of how to do all this stuff we just talked about. It keeps you on track and it keeps you accountable, right? And it connects you. So step one is it connects you to our lenders and vendors, right? And it gives you the green light where you can go talk to, line of credit bank XYZ. Or here's the account to the Uline guy, right? Here's the account for the utilities payment guy, right? Once you get to that point, you can start to use this guy. So you get the software. Number two, you get the access to our lenders and vendors who do report, who do give you the underwriting criteria before you apply, so right? So it can kind of speed things up. So you're not guessing whether stuff is being reported or not. And number three, you get a coach. So we're not going to just throw you to the wolves. There's a sorry. Again, I hope nobody on this call gets my cough, man. It's brutal. But anyway, you get a coach, credit analyst, who will walk you through this. And you have access to him as many times as you want. The typical process is roughly once a month, but it can be more frequent. It depends on where you are each month. Like the first month, it normally takes about 3 weeks to get all this data. But the guy our client yesterday was already in pretty good shape. So we're going to have his second call in week 2. He's already there, right? All we got to do is get him registered with that 411, and we got to get him an email address that doesn't say Gmail. Everything else he
That's
had.
a big one for a bunch of business too.
Yeah.
Again, that comes back to SEO. I know I'm pulling you away from your thing, but
No. I appreciate you're kind of like agreeing with me, I guess. You're kind of like validating this whole thing, right?
Mm.
And it's something you normally wouldn't think of, when you create your email address, or when you got enough other things to worry about, right? So,
so back to where we were, they're getting the coaching, their email,
you get
all
the coaching and all that. Yeah. So they get the coaching. You can call them as many times as you want. It's typically once a month. So the timing, some of it is do this, and you got to wait a month to see if all the transactions made it. And then you got to do this and that. So the timing, it depends on your availability, depends on where you are, depends on a lot of factors, depends on some external things out of our control. But I can say that it's sort of paint by numbers. It's not brain surgery. It's not rocket science, but if you don't know, you don't know. And so in addition to telling you the steps, we're going to also help you strategically. This is a big plus, I think, is what accounts can we open up that line up with stuff you're already buying that are going to report, like the next step, going back to the Uline. Is Uline a good, I think for all your clients, Uline is a probably pretty good
Uline and gas
option,
cards are great. Yeah.
right? So, and gas cards, right? So those are two obvious ones, but there are some other ones that might not be so obvious. We got to figure out stuff that hopefully we don't change what you're already spending to get you where you want to go. So that's the package. And again, it takes usually 9 months to a year. I'm supposed to say it takes a year, right? Because we don't want to, but some people are less, but let's say a year. So what does that cost? If you pay up front, it's $4,000. Okay. $4,000 for the entire year with a coach, the software, and access to our vendors. If you want to stay after that and keep access to the software, the coach, and our vendors, it's $100 a month maintenance fee for as long as you want to keep it. Okay, but we got to pay the coach. So that's what that is.
What does Dun and Bradstreet cost?
Say it again.
What does Dun and Bradstreet cost for their credit thing?
More than that.
Just well, as a funny comparison.
Over the course of it, I've heard different numbers, so I can't. I don't know. I mean, I've heard $1,000 a month. I've heard, that's a month.
Yeah.
I've heard more than that. I've heard, different numbers. I think they charge you based on your revenue, I think, but I don't know. I haven't looked into those details. I can just tell you, when you stop paying them, they stop inflating your number. So
love it. So 4K up front. Do you have a payment plan or a package?
There is a payment plan, but just let me remind everybody that that's tax deductible, right? So the net cost to you would be less. So there is a payment plan where you can go $333 a month for 12 months, which is almost the same price.
Yep.
So
that's very reasonable if that's opening up to the stuff that it's opening up to.
I mean, just think of the thousands you're going to save in interest alone, let alone the access to the capital, which is hard to quantify. What can I do if I had, if I needed to get a new van and didn't have to put it on my personal credit? Boy, how much would that be worth to you?
Well, so I'll put it another way too. If you're getting a $50K loan to cover something and you're doing it on personal credit, the terms you're going to get for that are not going to be as good as the terms you're going to get business wise. You're going to sink 4K real quick just in the percentage.
100%.
Yeah, so.
That's 100% correct. And where was I going to go with that? So yeah, you're going to get better terms. You're going to get significantly higher loan amounts, right? And again, it's all going to be against your EIN if you do it right. That's our whole goal, is to look. We can't eliminate every personal guarantee. The Small Business Association is always going to require a personal guarantee. But we can certainly eliminate most of them. And we do recommend the Small Business Association as something you should consider, depending on your situation. Here's what I was going to say. The caveat is you don't want to just borrow money for the sake of borrowing money. You want to strategically borrow it for a certain reason. You want to study the numbers to make sure that the return you're going to get on the money you're going to borrow makes it worth borrowing, and not just borrow it with no really goal in mind. Because that is a two-edged sword, and if you know what you're doing and buying a truck, if you can run the numbers, I would recommend working with an accountant if you don't know how to do that. But if you can show that I'm going to get 4 times the revenue of the cost of the truck, and the debt, because I have a business model that I can serve, that many more people, then you can accelerate your growth faster with debt.
Yep.
On the other hand, if you're sinking, and you're going to sink faster if you incur more debt. So you got to really have a plan. Okay, so
An
I want to throw that.
amplification tool. You're either going to grow faster or sink faster. Be
Exactly.
aware of which side of the roller coaster you're on.
100%, man. 100%. And the last thing I was going to say, which of course slipped my mind. So when you get old, you get. But anyway, we'll keep it at that.
This has been great, Murray. Appreciate you walking through that. Appreciate you answering my questions. I've put your website up here. I'll put it in wherever we post this as well. TBCEsolutions.com. They're going to help catapult you into the next level. I think discover a new trajectory for your business is their tagline on the website. But Murray, this has been great. Appreciate you coming on. Appreciate you sharing your time. Guys, if you have questions, you can reach out to him on the website, on his website there that I've got up on the screen. But,
I'm also on LinkedIn. If you're on LinkedIn, I'm a big LinkedIn guy. We have a whole bunch of other things we can do, but we want to make sure we get your credit straight.
Yeah. It's kind of the foundation, right?
That's the foundation, right? And that gives you the tools to do a lot more things like hire Lewis, right? And other things that you might not have thought were possible. Well,
this has been a blast, guys. Take action on this, even if you don't connect with Murray. Start looking into this stuff. Get your mind around this. This is important. If that $18 million story didn't pique your interest, maybe go listen to this again, because there's lawsuits. There's anything that could happen, and if you're not protecting your personal assets, your home, your family, all of that, why are you in business when it could be taken away? So appreciate your time, Murray. Stick around for a second.
Appreciate you, man. Yes, I will. And thank you very much, Lewis.
Joshua's just asking here. I've got a couple questions here. Joshua's asking, Steve is asking, is it recorded? It is recorded. I'll message Steve after. Joshua is saying website. So just look on the screen here, but it is TBCEsolutions.com. And I'll post it in the comments as well for you, Joshua. But Murray, once again, appreciate it. Guys, appreciate everyone that tuned in. We had some people here right from the beginning. So
awesome.
We will see you guys next time. Stick around for a second, Murray, and we'll just wrap up. All right.
Thanks.
Talk soon, guys.
Thanks for the pleasure.